Hello and welcome to this online webinar. The webinar is in two parts. The first part, which you are currently watching, covers questions on IS-36 impairment. The second part, which is a separate video, will deal with questions on IS-37 provisions. In each part, you will be asked to pause the video and attempt a question by yourself first. Once you have attempted it, you should resume the video to compare your answer with the solution offered in the video. At the end of each part, questions you should attempt as homework are identified. You are required to solve these questions and bring your answers to the following seminars when they will be checked. Okay, so let's start. The first part we are dealing with today is IS-36 impairment. The questions are given on this week's section on the Moodle. So please get the questions on IS-36 impairment. The document is called seminar questions. Okay, and then resume the video so we can look at the questions together. Right, so this is the document. We are looking at the first four questions, starting with the first question. It is about recoverable amount and impairment. What you are required to do is calculate the recoverable amount of each asset and calculate the impairment loss of each asset. So the information given to us covers information related to three assets of this company. All right, the assets are A, B, and C. We have been given carrying values of these assets. We have been given net realizable values, which is also known fair value less cost of disposal, and then value in use. First thing we need to determine is what are the recoverable amount of these assets, assuming that the impairment test is taking place. And once we have determined the recoverable amount, the next thing we need to find is the impairment loss, if any. Pause this video at this point. Spend 5 minutes on this question. It is not very difficult. Find both the items and return so we can look at the answer together. Okay, so now if you have had a chance to look at the question, prepare the answer, let's give you a chance to compare your answer with what the answer should look like. In the lecture, we discussed that the impairment on an asset exists if the carrying value of the asset is greater than its recoverable amount. So we need to compare recoverable amount against the carrying value. If the carrying value, which we also call book value, is not a true representation of what you can recover from the asset, then the carrying value will need to be brought down to the recoverable amount. Okay, simple as that. So first thing, we need to find out what the recoverable amount of the assets are. And according to IS-36, the recoverable amount is greater of fair value less cost of disposal, which we also call NRV, and value in use. All right, so let's check which one is higher for each of the assets. Asset A, we can see value in use is greater. So if we keep the asset within the business instead of actually selling it and getting the money, we will generate more cash flow. Asset B, same case. If we actually keep it in the business and use it, we'll generate more cash flow. But asset C, if we sell it, we'll get £10,000 more than what we will get if we keep the asset within the business. All right, so for asset A, value in use, asset B, value in use, and for asset C is the net realizable value will be the recoverable amount. So let's prepare the answer now. So it's going to be a pro forma like this. Okay, three assets in thousands. We are working in dollars, not pounds this time. Recoverable amount, as we discussed, right, on 20, 130, and 100. Carrying value as per the question. And this should tell us whether there is an impairment or not. Now, if we look at asset A, is actually recoverable amount is greater than the carrying value, so there is no impairment loss. On the other hand, asset B and C, because the carrying values are greater, will have impairment of 20 and 20. Now, so that we have worked out the impairment losses, let's put it in yellow. So now we can account for it. If the asset was not previously revalued, then the entire impairment loss will go to the statement of profit or loss. In this case, the assets were not previously revalued, so we are going to take the entire loss of this 40,000 to statement of profit or loss. Okay, it's debited to statement of profit or loss of income. We are going to reduce the carrying value of asset B, 20,000, okay, by charging the impairment to accumulated and depreciation account. Okay, so increase that account so the carrying value comes down. Same for asset C, and job done. Okay, so we are reducing the value of the asset and charging the loss, this one-off loss, to statement of profit or loss. Question 2 now is similar. All right, a company owns a car that was involved in an accident at the year end, right? It is barely usable. Okay, it's not usable. So the value in use is 1,000. If we keep it within the business, it can generate only 1,000. However, the car is classic and there is demand for the parts. This results in a fair value less cost of sell or cost of disposal is 3,000. Okay, the opening carrying value was 8,000 and the car was estimated to have a life of 8 years from the start of the year. Now bear in mind, in this case, the impairment is taking place at the end of the year. Accident happens at the end of the year. You have been given carrying value at the start of the year. So what we need to do is actually work out the carrying value of the car at the year end, so that we can then compare it with its recoverable amount and see whether there is an impairment loss or not. So our job is to identify recoverable amount of the car and any impairment, right? So have a go at this question. Let's spend 5 minutes, return back to the video, and then we'll look at the answer together. Right, so now if you had a chance to prepare your answer, let's see what the answer would look like. So first of all, the carrying value of the asset on the accident date. We know at the start it was 8,000. We are also told that the asset, the car, was estimated to have life of 8 years. So we need to take away depreciation worth of 1 year from this 8,000 pounds. So 8,000 divided by 10 years gives you 800. Take it away from the opening carrying value, and that should give you, let's work in dollars, 7,200. Okay, recoverable amount we know is higher off fair value less cost of disposal, which is cost of sales in this case, and value in use. So which one is higher? Of course, if we sell it, we are going to get more. So we are going to use that as recoverable amount. Okay, and that should give us, right, impairment. Let's do the calculation here of 4,200. Right, so that's our impairment. How are we going to account for it? Again, the asset was not previously revalued, so the entire loss is taken to the statement of profit or loss, and we are going to credit the depreciation, okay, and impairment account, accumulated depreciation impairment account by 4,200. It is in text, not figures. So yeah, 4,200 will reduce the carrying value of the asset. So carrying value was 7,200, will bring it down to 3,000 by charging extra 4,200. Okay, good. Now let's look at question 3, slightly different. Okay, we are in question 3, we are dealing with an asset which was previously revalued. An entity owns a property which was originally purchased for 300,000. The property has been revalued to 500,000 in the past with revaluation of 200,000. That's a gain recognized as part of other comprehensive income and recorded in revaluation reserve or surplus. So in the past, the asset was revalued, 200,000 pounds worth of gain was taken to revaluation surplus. Now what is happening? The property has a current carrying value of 460,000. The recoverable amount of the property is 200,000. So the value recently has declined. Our book says it's 460, but in reality it should be 200,000. Okay, we have been given recoverable amount over here. We don't need to find it. We just need to find impairment, right? And we'll need to see how we're going to account for it. So that's our main job. Pause the video, spend 5 minutes, prepare the accounting entries, find the impairment first, prepare accounting entries, and then come back to the video. Okay, now let's prepare answer 3. So we know that the carrying value before impairment was 460,000. Oops. Yeah. Recoverable amount is 200,000 and therefore impairment loss is 260. Okay. So we know the impairment. How much is the impairment? The important thing here is to do the correct accounting treatment. Okay, accounting treatment. So we know that the rules say that if there is a previously recognized gain on the asset sitting in revaluation surplus, whatever loss we have now should be settled against that gain first. So how much do we have sitting in revaluation surplus? 200,000, right? So we need to set off 200,000, okay, of loss against that gain first. So let's do that. 200,000 of the of gain on the property exists in the revaluation surplus, and therefore we're going to set off 200,000 against it first. How much left after settling 200,000? 60,000 pounds worth of loss, isn't it? That will go to statement of profit or loss, the remaining impairment loss. And then we are going to charge 260,000 pounds against the carrying value of the asset. Therefore, we are going to bring the carrying value 460,000 down by 260, and therefore the recoverable amount will be recorded as the new value of the asset, 200,000. Okay, so we charge 260 to the accumulated depreciation and impairment account of the asset. We bring it down, okay, the value of the asset by charging it. Cool. So this is how we deal with an asset which was previously revalued. Okay, if there was a revaluation, first of all, the loss must be taken to revaluation surplus first. Anything left should go to statement of profit or loss, and the total loss will reduce the carrying value of the asset. Okay, so that was question 3. Question 4 is about cash generating unit. Let's make it slightly bigger so we can see. A cash generating unit, just to remind you, is a smallest group of identifiable assets, okay, which are not capable of generating cash flow on their own. So things like brands, land, building, they're not able to generate cash flows on their own for the business. They need to work in combination with the other assets to generate money for the business. Now, because they are not capable of generating cash flows on their own, if there is an impairment on such asset, what we cannot determine, can you think? What we cannot determine in order to check whether there is an impairment or not is actually this thing, value in use. All right, value in use is the value of the present value of the future cash flows the asset will generate. All right, now in this case of CGU, it is not possible because the assets cannot do that on their own. So what we need to do really is identify, instead of actually checking the recoverable amount of each of the assets, which is not possible in this case, against the carrying values, we work out the recoverable amount of the entire CG, cash generating unit, and which in this case is given to us, and that is compared against the total carrying value of all the assets within the CGU. I can see if there is an impairment exists for the entire CGU, entire cash generating unit. So once we have found that impairment for the entire CGU, we can then allocate that impairment to the individual assets within CGU in this order. So the IS 36 says that any impairment that exists on CGU first should be given to goodwill or any obviously impaired assets. So if some assets are totally needs to be written off, okay, that the impairment loss should be given to it first. Then we use the goodwill amount to set off the impairment loss as the second ranking. And thirdly, if any impairment loss is left, we allocate that loss amongst remaining assets on pro rata basis according to their carrying values or book values. Now we have to be careful that while doing that, we cannot reduce the value of the asset, okay, below its net realizable value or fair value less cost of disposal. So if certain assets already represent as book values in according as their book values, their fair value less cost of disposal, we cannot actually reduce it any further. Let's read through the question and apply those rules. A company runs a unit that suffers a massive drop in income due to a failure of its technology on 1st January 2008. The following carrying values were recorded in the books immediately prior to the impairment. So we have goodwill, technology, brands, land, building, and other net assets. The recoverable value of the unit is 85 million. So entire CGU is worth 85 million. The technology is worthless. So we need to write it off first of all. Okay. The impairment loss will be given to it first, following its complete failure. The other net assets include inventory, receivables, and payables. It is considered that they are true representation. This 40,000 is true representation of the net realizable value. So if they represent the correct net realizable value, no further impairment can be given to them. So after allocating impairment loss to technology and goodwill, if any loss is left, that will have to be allocated amongst brands, land, and buildings. Still, if anything left, then it will be recognized as a liability. Okay, but we are not going to touch the other assets. So have a go at this question first. Let's spend 10 minutes on it. Return back to the video and we'll prepare the answer together. Okay, if you now have had a chance to look at the question, prepare the answer, we are going to prepare it together. Right, so first of all, we need to work out the carrying value of CGU. All right, so if you add up the total list, okay, you will find the total value of CGU. Okay, so let's write carrying value of CGU. Oops, not I, U. And that is 20 plus 5 plus 10 plus 50 plus 30 plus 40. That's 155, and that's in millions, right? Recoverable amount as per the question is 85. Okay, and impairment, therefore, of the entire CGU is 70. Okay, so we need to allocate the 70 loss amongst these assets. The order of allocation, if you remember, first of all, we are going to write off the technology because it's totally worthless. So technology will be written off by 5. Then comes the goodwill, which is going to be 20. All right. How much left? Out of 70, we have utilized 25. 45 million pounds worth of loss left. Okay. So remaining 45, we are going to allocate to the assets on pro rata basis according to their carrying value, but we are going to leave the net assets alone. So for example, we are going to give sum to brand name. How much? We'll see. So number 3, brands, remaining loss 45, value of brand, book value of brand 10 million. Okay, and if I add 10 plus 50 plus 30 for brand, land, and building, which we are going to be using to allocate impairment loss, I get 90. So 10 over 90, and that gives me 5. I will do the same for land. Okay, value of land as per the books 50, overall 90. Okay, 45, so 25 given to land, and building same 50. Okay, so we know the order now. Now let's allocate the loss. Let's do some calculations here. We'll need a nice table which will look something like this. So first details column, then carrying value in millions, impairment in millions, and then recoverable amount in millions. So we can reconcile our answer. So first of all, let's list all the carrying values. Okay, just copying the question. All right, I'm just copying the question. The brand is 5. Okay, brand is sorry, technology is 5, goodwill is 20. Sorry, brand is 10. What am I doing? Brand is 10. Sorry, my fault. Right, now let's allocate the impairment. We said we're going to write off the technology 5, then goodwill 20, right? Then trans 5, land 25, building 15. We are not going to give any impairment loss to other net assets because they are true representation of the net realizable value. And if I add that up, I get 70 worth of loss. Okay, 70 impairment loss, right? And therefore, if we do the calculation here, 5 minus 5, 0, add up. And if I add up the entire column, I should get 85, which is the recoverable amount of the asset. Okay, so got it. Let's go through it one more time. Because CGU individual assets, we cannot work out value in use. We can't work out recoverable amount of each of the assets. What can we do? We can work out the recoverable amount of the entire CGU. Okay, which we can, as per the question, compare the carrying value, total carrying value of CGU's assets against it, which is 155. Find the impairment loss for the entire CGU, and then give the impairment to the assets within CGU in this order. First, obviously, impaired assets, which you need to write off completely. Then to goodwill. Then, if any loss left, it will be allocated amongst the assets on pro rata basis according to their carrying value. We have done that here. While doing that, we have to make sure that we don't reduce the value of the asset, okay, recoverable amount of the asset below its net realizable value, and therefore we did not touch net realizable value of other net assets. So leave that alone. So we got the order. Now we allocate the impairment, right? Allocate the impairment. So this is our accounting, carrying values, impairment, and the recoverable amount. At the end, you should do the total to make sure your answer are reconciled. So carrying value should add up to 155, impairment should add up to 70, recoverable amount should add up to 85. Got it? That's brilliant. Wonderful. Thank you. What we can do now is we are not going to look at the entire question 5, but this is a comprehensive question which I'm going to ask you to do as homework. All right, so try question 5, impairment of assets. Once you have done that, bring your answer to the next seminar session when we are going to have a look at it. Okay, I'll check your answers and make sure they are in order. So thank you. Now go to part 2 of this webinar and look at the provisions question. Thank you very much.